The Treasury announced they're doubling bond buybacks. Gold spiked 3 to 4%, and by Friday, the 30-year yield was higher than it was before the announcement. The intervention failed, and that's actually the most bullish thing that's happened for gold in years. By the end of this video, you'll know exactly why Treasury made this move, whether this is QE or something different, and why the bond market rejecting this intervention in 48 hours is the signal gold traders have been waiting for. If you trade gold or treasuries without understanding what happened this week, you'll misread every move between now and November. You'll be trading the headline instead of the mechanism, and that's a fast way to be on the wrong side of both. Let's start with the setup, because the numbers behind this move matter. The national debt crossed 40 trillion. The 30-year Treasury yield hit its highest level since roughly 2007. That's pre-financial crisis territory. And the interest bill on that debt is now above 1 trillion a year. That's more than the entire Medicare budget. So Treasury stepped in. They announced they're doubling bond buyback operations in the 10 to 30-year range, from $2 billion per operation up to at least $4 billion. The program runs from September 9th through November 4th. The day of the announcement, gold jumped back above $4,500 an ounce. The dollar fell. The 30-year yield dropped about 10 basis points. Secretary Bessent said the $4 billion figure was a floor and that yields don't reflect the underlying fundamentals. When you see the government buying its own bonds, your brain goes to QE, quantitative easing, money printer, inflation trade. That's the wrong read, and getting it wrong puts you in the wrong trade. This is not QE. Here's what's actually happening. Treasury is swapping long-term bonds for short-term T-bills. Treasury creates no new money. The Fed isn't involved. The total amount of debt outstanding doesn't change. They're just shortening the maturity. This comes from the Treasury Department, not the Federal Reserve. Different building, different mechanism, different consequence. The instinct behind it is the same as QE, the government absorbing its own debt risk. But it's not the same tool, and that difference matters for what happens next. So if it's not money printing, why did the bond market reject it in 48 hours? Announcement day looked like a clean trade. Yields down, gold up, dollar down. If you were watching that afternoon, you might have thought Treasury found the ceiling on long rates. They hadn't found it, but the market did. By Friday, the 30-year yield was sitting at 5.27%, higher than before the announcement. The 10-year erased its entire decline. Jefferies called it shot from the hip. JPMorgan warned that intervention may have raised the term premium on treasuries, and that the damage could be lasting. The act of defending the price made investors demand more yield just to hold them. Treasury is buying $4 billion per operation, but they're issuing $550 billion in new debt this quarter. That's the ratio, $4 billion against $550 billion. The bond market looked at that math and said no. But here's what the failure did expose. The government's pain threshold is now public. Around 5.3% on the 30-year is where Washington blinks. That's the line they couldn't hold. And now every participant in this market knows exactly where it is. Here's what most people are getting backwards. Treasury losing is exactly what gold needed. And I'm going to show you why. The default read on a failed intervention is bearish for gold. If the government tried to cap yields and couldn't, yields stay high. High yields mean a stronger dollar, and a stronger dollar is supposed to push gold down. That's what the textbooks say. But the textbook is missing what's underneath this. Think about what the announcement actually revealed. The Treasury had to defend the price of its own debt. The issuer stepped in to support the market for its own bonds. And it didn't work. That risk premium warning goes deeper than a headline. Investors now want more yield to hold treasuries, to compensate for the risk that the government might try to manage this market again. Their safe asset just picked up a qualifier. Look at what happened to that correlation over the past quarter. Yields rose, and so did gold. The textbook relationship is already gone. Now add this number. In Q2 2026, central banks bought 288.9 tons of gold, a quarterly record, and they bought it while the price was still falling. Before this announcement, before the buyback program, before the yield hit 5.27%. They weren't buying because gold was going up. They were rotating because of what treasuries were becoming. If the intervention would have worked, if Treasury had successfully capped the 30-year at, say, 4.8%, Treasuries would have looked fine. Investors would have stayed in bonds. Gold would have had nothing to make a case on. But it didn't work, and now the market knows that the entity issuing Treasuries can't control their price. That adds a new category of risk to holding them. Not default risk, not inflation risk alone. The risk that the issuer is actively trying to manage what you paid for and may not be able to stop. Central banks figured that out an entire quarter before retail did. Now you know the mechanism, but you need to know what to watch for confirmation that this gets worse or resolves. There are exactly 2 dates. Treasury's buyback strategy is a directional bet, not a neutral operation. When you swap long-term bonds for short-term T-bills, you're shortening the average maturity of that debt. You're betting rates come down. If they do, the short-term debt rolls at a lower cost when it matures. If they don't, the debt reprices at whatever the market demands, and the cost compounds every time it rolls. And the Fed isn't helping Treasury with this. Kevin Warsh has been pushing to shrink the Fed's balance sheet, not expand it. Inflation is still above target. Before the last jobs report softened, 2 rate hikes were on the table. These 2 institutions aren't working together. Treasury is making a bet the Fed isn't backing. So here are the 2 dates. September 9 is when the buyback program goes live. Watch the participation rate. Watch the bid to cover on these operations. If the market shows up and demand is real, yields hold or drift lower, and the intervention gets traction. If participation is weak, if the dealers shrug, you'll see it in the yield print the same afternoon. November 4 is the quarterly refunding announcement. That's where Treasury lays out the next issuance schedule and the structure of any ongoing buybacks. That's the binary. If Treasury makes the buyback program permanent on November 4, they've made managing their own borrowing cost permanent policy. That's not a one-time panic. That changes what Treasuries are as an asset class, and it tells you exactly where gold's floor sits. Because a Treasury market that can't price itself without official support isn't competing with gold anymore. It's driving demand for it. If it does stay one time, if they step back on November 4 and let the market run, the bond market prices that in the same week. You'll see the yields move, and you'll know which scenario you're in. The Treasury stepped in when the 30-year hit 5.33%. The bond market reversed nearly the entire move in 48 hours. That failure didn't break the gold trade. It defined it. The government's pain threshold is now public. Every time yields push back towards 5.3%, the market knows Washington will try to intervene. Every time it fails, the credibility cost goes up. Central banks were already rotating a quarter ahead of retail. The 288.9-ton record buy, while prices were falling, is the proof. And between now and November 4, every data point is telling you which scenario you're in. Every yield print, every bid to cover on the buyback operations, every statement from Warsh. Either way, the answer to the question that you came in with is this: a Treasury that can't hold its own price is no longer the safe alternative to gold. It's the reason to own it. Here's what understanding this story doesn't give you: the truth about the direction of price. It gives you a narrative, and narratives matter. But price is what tells you whether the narrative is true or not. The measured move is a framework for understanding the direction of price. It tells you whether this story is being confirmed by price or not. If you trade on a narrative without that framework, you could be on the wrong side of a trade for days, weeks, or even months, while price tells a completely different story. That framework is what I teach. The traders in my community use this story to understand their environment. They use price to understand the trade. And when those two things disagree, they follow price. They may be trading in the opposite direction of consensus until price changes and tells them something different. They have a process for knowing when that happens. That's the process I teach every day at eminiaddict.com.